Hey, what's up, everyone? My name is Patrick. Hope you guys are having a great day. And today I'm just going to talk about why investing is important and why I think you could get easily involved in it. So, just a little bit about me and my journey. I'm 25. I've been born and raised in the UK my whole life. And I always thought this world of investing and finance is definitely too scary for me and too risky. I don't know enough about it. But I've kind of studied myself. I'm definitely not a financial advisor or in any way qualified in that regard. But it's just kind of some of the things I've just learned over the course of the last couple of years. I used to be the type of person that would just always put their paycheck into savings. Then I started getting a bit more adventurous, and I started buying into Bitcoin and Ethereum and other cryptocurrencies. And in 2017, there was a massive spike. Bitcoin hit $20,000. I was like, this is it. I'm going to be rich. I'm going to be able to retire. But as with all things that are usually too good to be true, it was. Um, it came crashing back down to $4,000. And it's kind of some of the lessons and mistakes that I'll hopefully be sharing in future videos with you guys. I'll cover the easiest way to kind of start getting into investing, which is through funds investing. And then in future videos cover individual stocks and trading and into more detail into other topics. So in this video, I just wanted to cover the main kind of two topics, which is saving versus investing. And how you can build and preserve wealth, banks versus the market. So typically, at least for me, growing up, a lot of the people around me, my parents and family, would only really ever save money. They'd put it into a savings account with a bank, get interest rate, and that's kind of the world I always knew. Which was the safest way because you don't really lose money unless the bank goes under, but usually you're fairly protected. And the stock market was always this kind of mysterious place where you could make a lot of money but also lose all your money. And I just never really delved into it or knew about it. I'm going to be talking about funds, inflation and cash, and just the bread comparison. So what is a fund and how can you kind of start getting invested? So a fund is essentially just buying a tiny bit of each company. Think of it as these loaves of bread that you see on the screen. You buy a bit of the sesame loaf, you buy a bit of the buns, buy a bit of the bloomer, and instead of having one loaf of bread, you have a tiny bit of each loaf of bread. And you might be like, why would I want a tiny bit of each? Why not just have one whole one? Well, say one bread was just deemed to fail and just cause you, I don't know, stomach upset. You'd be happy that you have a bunch of different loaves so you can eat the other ones instead of having one whole spoiled one. And this is kind of what a fund does. So the UK has the FTSE 100, which is top 100 UK companies. And when you buy a fund, you buy into each of those companies with a tiny fraction of your money. And the majority of these companies are fairly established and do pretty well. If one does go under, the rest of the company's success kind of takes the hit and your money still grows. If you were to purchase just one company and that company failed, then you obviously lose a lot more of your money. And this is why I think funds are the best way to start for people to get into the world of investing, because it's typically the safest and does give you pretty good returns. The USA has the S&P 500, which has an annual return rate of 7%, which is really good in comparison to banks' interest rates. I know last year for my ISA account I got 1.5%, which is not great in comparison to 7%. Obviously, as it is the stock market, you do have periods where the drawdown is really big. So during the 2008 financial crisis in the world, the S&P 500 dropped by 38% in just 1 year. So it does vary, but typically you have a 7% return, and some of the years are even better where it's 30 or 40% return. So it just varies. Poland has the Big 20, and just most countries have an indices that you can invest in, if not more than one indices. And it kind of covers why I think it's important to invest. So I mentioned like my cash ISA had 1.5% return, and the price of bread in the year 2000 was 70.2 pence, whereas the price of bread roughly now is 118 pence. And you kind of see this graph of how the price of bread has been just steadily increasing year on year. And this is just due to inflation. The cost of goods increases over time. You've probably noticed how your phone bill tends to go up each year a tiny bit, or your cost of a house, whatever it may be, kind of goes up with time because the cost of goods goes up over time. And in the year 2000, £1,000 would have got you 1,429 loaves of bread. That's a lot of loaves. And if you invested that £1,000 into a cash ISA, 1.5% return from interest, you would have a total of £326 left. And at the end of the 20 years, you could only buy 1,125 loaves of bread, which is almost 300 loaves less bread, which, as someone who loves bread and toast, kind of makes me angry. If I bought into the S&P 500 in the year 2000 and had an average of 7% total return, I would have a total of £2,616 of profit. So both are positive, but the big difference is I can now buy 3,065 loaves of bread, which is more than double the loaves of bread I could buy if I just kept it in a cash ISA. And if you timed it at the worst possible time, say you bought in and it dropped 38%, like it did in 2008, if you just held on and didn't sell through the loss, through the panic, you would still end up better off in the 20-year period, and you could still buy more loaves of bread than otherwise. And this is kind of just how investing is so important, because you can really build your wealth and grow your wealth through this kind of method. And it's just something that everyone should be kind of getting involved in, or at least starting to dabble their feet in. And there are quite a few different ways to get involved. In the UK, we have Trading 212, Hargreaves Lansdown, Fidelity. There's a lot of different options of how you can get involved into index fund investing. And the best way to probably start is just dabble a tiny bit. For some accounts, you can create a practice account, and you can just buy a tiny bit of a fund and see how it changes over time. And as you kind of read up and grow more confident, you can start purchasing larger sums. But it just kind of highlights the difference between savings and investing, and the return is really substantial. You do have to be a bit more adverse to risk, and depending on the different timelines, there's different types of ways to invest, and I'll be covering some of those in future videos. So I hope you guys had fun watching this video. I hope you're a bit more informed. If you could like and subscribe, that would be awesome for my channel, and I look forward to making more videos in the future. See you guys in a bit.